Despite today's big rally, October has been a rough month for the markets, with 70% of the S&P 500 now in correction. Bob Pisani is live at the New York Stock Exchange. Hey, Bob.
At least we got out of October alive. You know, we had a terrific rally. It lifted the Dow 1,000 points from Monday's lows, but it couldn't obscure the fact that it was one of the ugliest months in years. The S&P was down almost 7%, its worst month since September 2011. Now, there were several themes. Number one, most importantly, a slowdown in global growth concerns in Europe and China. On top of tariff issues, that was number one. It badly damaged the big energy, industrial, and material names you see here, all down double digits for the month. Technology was hurt by big worries about a slowdown in semiconductor demand and a takedown in the high-growth FANG names. Consumer discretionary hurt by a big drop in Amazon, and a brutal month for housing stocks, concerns about higher rates and slower sales. Now, consumer discretionary, this is a very good example of what happens when a stock becomes too dominant in any one sector. Amazon is about 23% of the weighting in consumer discretionary. That's too much, and when it dropped, the whole sector dropped. Then you throw in the big declines in Home Depot, D.R. Horton, and the home builders, the appliance makers like Whirlpool on these housing concerns, and you can see why it was a rough ride for consumer discretionary. Not surprisingly, when the market turned late Monday, these most oversold sectors you saw there were the ones that bounced the most. So communication services, that was helped by that big rally in the FANG names, Facebook, Netflix, Alphabet, they're all in that one. Now, for November, watch the buybacks. November is the busiest month for buybacks, and corporations have plenty of dry powder available to buy back their stocks cheaper. And the king of buybacks has yet to report. Yeah, you know that one. Apple reports tomorrow after the bell. They are by far the biggest user of buybacks out there. In the first 6 months, the company repurchased about $44 billion of its own stock. They could buy back $100 billion in stock this year. That would be 10% of all the buybacks. They've already, Melissa, this year reduced their share count about 5%. That's remarkable. 25% reduction in share count in the last 5 years. Melissa?
All right, Bob, thanks. Bob Pisani at the NYSE. Well, let's talk more about beaten down areas that are beginning to look like a buy. Rob Sluymer of Fundstrat Global Advisors is at the Plaza. He's ready to break it down for us. Hi, Rob.
Hey, Melissa. So obviously the cyclicals, as Bob pointed out, have been just hammered over the last number of months, particularly going into October. We're going to look at three sector charts: energy, industrials, and then materials. And we can see just the weakness. I think there's a couple of points to be looking at. First off, when we look at these long-term charts of the sectors in top panel, relative performance in the bottom panel going all the way back to 2008, once again, this relative performance in the bottom panel is such an important indicator of where that leadership is in the market. Note that big divergence between real and relative price going into 2014 and 2015, and it's continued to bleed lower. It's really kept you out of these sectors. There's potentially some bottoming action starting to develop on a relative performance basis. It's still very early, and we can see that the price of the energy sectors come down into some support. So while it's a very small picture on this particular chart, a lot of these energy names have just been hammered and they're fairly oversold. We're starting to see some bounces take hold. Now, when we look at the materials sector, we have a similar sort of profile, right? That relative performance diverging meaningfully from absolute price and really weak going into the last couple of months, breaking down through this big trading range that we had all the way through 2018 with the absolute price, the real price of the index, back to that 200 week. And that tends to be a pretty long-term support level. And then lastly, when we look at the industrials, again, you generally have an uptrend in price, and relative performance has been much more mixed. Big sideways trading range, and you're roughly down at the low end of that range. And again, at that 200-week moving average, they're setting up for bounces. So Tom Lee put out an interesting note this morning highlighting when the most oversold sectors crack the way they have, they get deeply oversold, they tend to snap back, and we're starting to see that here now. So what do you buy? I still like charts that are in better technical profiles. There's lots of names you can buy that are dumpster stocks that are deeply oversold. But here's Conoco in the energy patch. It really hasn't broken down. This is a daily chart. It only goes back a year and a half. And it's sitting at some very important price support right at its 200-day moving average, and is starting to hook up. And you're starting to see a little bit of relative strength. So that's an interesting name in a beaten down sector. Next, if we look at the industrials, and these are all stocks that rank very highly on our quantitative model, Sam Doctor's DQM model. These are all in the top quintile. And here's Norfolk and Southern. So again, you can dumpster dive, but here's a stock that's corrected back into a lot of support, right to the 200-day, and that relative strength is starting to hook up as well. So good-looking charts, still in uptrends, bouncing off the 200-day, relative strength's improving. I think those are healthy names to be looking at within these beaten down sectors. And lastly, well, this is a weaker name, and this is a weekly chart going much farther back to 2014. Air Products, again, highly ranked on our quantitative model run by Sam Doctor, off the 200-week moving average, the 4-year moving average, and you're starting to see very early signs of a positive divergence. So those are 3 names. If you're looking to be buying in the cyclical area, those are the names I'd be looking at.
All right, Rob, why don't you come on over? Stephanie will bring the chair in.
Nice.
Thanks, Stephanie.
Way to go, Stephanie.
How you doing?
So in terms of seeing these sectors as due for some sort of a bounce, the
Yes.
sectors seem to paint a picture of a strong economy or strengthening economy.
On the bounce.
Saying that these sectors are going to bounce, materials, energy, and industrials.
Well, they're certainly in longer-term downtrends. I think we want to be, I want to separate, at least technically, the difference between stocks and sectors in downtrends, deeply oversold and staging oversold recovery rallies, which I think could last right into year-end, possibly into the first quarter, seasonally strong periods of time. So very depressed, almost like a beach ball being pressed down, they pop back up. But I'm not convinced there's sustained leadership in 2019. I'm still concerned technically on the whole market cycle that began in 2016 is fraying. You're starting to see lower highs. You're seeing trend breaks develop across emerging markets, IFA, cyclical sectors like financials and industrials. So a tremendous trade, but unlikely sustained leadership from a technical standpoint.
So really interesting because you just threw a bunch of stuff in there. Look at the XLI. And so Mel's question really was like the picture you're painting is that if those sectors are going to rally, that would suspect that the economy is improving because those sectors would benefit. Look at the XLI. It just broke that 2-year uptrend it's been. It made a massive double top from earlier this year to just recently. It's down in a straight line 20%. What do you expect out of a group like that is really important as an input to a lot of people trying to figure out what's going on in our economy?
Well, it's a great question. So when you look at most of the cyclicals, right? Banks, industrials, materials, all of these have broken those 2-year uptrends, 2 to 3-year uptrends. And again, if the cycle bottomed in 16, 2.5 years into what I think is a normal 4-year cycle, we're looking for a major low in 2020. 2019 is probably rough, but you do get these counter trend moves. And I think that so many of these names have just been hammered certainly over the last couple of months, but many of them started to peak back in the beginning of 18. Those trend breaks tell you there's a bigger problem, in my opinion, from a technical standpoint.
So you picked Air Products. Was it anything specific to them, or was just the chart that compelling to you?
So it was a very different chart from the other 2 that I picked. The other 2 were still in rising uptrends. The 200 days still rising. They came right back down and started to bounce. Air Products screens very well from a quantitative standpoint on our Sam Doctor screen, which I think is a good screen to filter out the best from the worst, fundamentally. And then from a technical standpoint, it's right at that 200-week. And I often find that 200-week moving average is a very good long-term support level. And you're starting to see some relative performance divergence. In other words, price has gone to a new price low, relative performance has not. So that always grabs my attention.
Who's the Sam Doctor you keep mentioning over at Fundstrat?
Well, Sam is our quant data scientist.
You mentioned it like 4 times.
Doctor. The doctor's in.
Incredibly
Is that
bright
his
guy.
actual name, or is he?
It absolutely
okay.
is,
All
and
right.
incredibly bright. Helps me out all the time, and he's got this terrific model that
Good
we've
doctor.
been looking at that tracks very well. And it's a great screen. The quintile 1 stocks continually outperform, not every month, but most months. Quintile 5s are where all the disasters are. You just want to avoid them.